I had some remarks. I don't know if there's a prompter. Yeah. Yeah. I have detailed remarks, but maybe I'll try to go through them quickly since I have 10 minutes. I'm an associate general counsel at McGraw-Hill Financial. Two of our companies, S&P Dow Jones Indices and Platts, are both independent benchmark providers. Platts is quite renowned in the commodities benchmark space, in oil and other commodities. S&P Dow Jones Indices is a leading provider of equity and fixed income indices. Most folks in the benchmark world, many of whom are here and have gotten to know over the last couple of years, are familiar with our companies generally, so I won't go into any more detail. And Dave Ernsberger, the head of oil editorial for Platts, is on the next panel, so he can talk a little bit more about the business in that context. I guess maybe because I'm a lawyer, I wrote a lot of words. I also did what was a bit of a Pavlovian response to the questions that were asked of on the QED invitation, but just wanted to talk a little bit about some of those questions in context and the transparency and the necessity or the desire to increase transparency. And what I would say to that, as well as what benchmarks should and shouldn't be used for, and what I'll say to that, and I'll run through it as quickly as I can, is to say that many benchmarks that are published in the world, including by independent index providers, are already highly transparent. I mean, if you look at the S&P 500, we published a methodology. We have data subscriptions available to anyone who wants one that allows you to have access to all of the data. The same is true in the Platts space. If you look at the Brent crude oil assessment, we've been talking over the last couple of days. I've been talking with Dave and others around Brussels, and that market is actually one of the most transparent markets in the world. In fact, it's a lot more transparent than on equities markets, for instance. So it's baffling to us in a way that people say that some of these markets aren't transparent. Indeed, Dave said something yesterday which resonated a lot with me, and I hadn't really thought about in that context before, which was a lot of his job as the global head of editorial for oil for Platts is letting people know what information is out there about the oil markets. Not that it's not available. It's all available. He's trying to point people to it. So I would say that a lot of them, a lot of the benchmarks that are published are already highly transparent. To the next point, we've talked about clear and explicit and transparent methodologies. If you look at a methodology, the U.S. methodology for indices, the S&P 500, or you look at the Platts Brent assessment methodology, those are highly detailed and highly transparent, and we publish them to everyone who wants. You can go to our website and see it now if you'd like. And that is a detailed methodology, and again, Dave can talk a little bit more about Brent, but it has what we do to measure those markets. It has what we expect in terms of the data input. And so anyone who wants can know exactly how we measure those markets. And indeed, partially as a result of the implementation of the IOSCO principles, to make those things even clearer, we now publish assessment rationales with the assessments. They talk about what data we use, what data we didn't use, and how we measured those markets on a daily basis for those assessments. The same is true of the S&P 500 and equity indices that are published on the S&P Dow Jones side of our house. The next question asked was, should there be restrictions on the use of benchmarks? I think the first thing from our perspective as an independent index provider is that it's really the market that determines whether something becomes a benchmark. If you think about an equity benchmark, if people want to license it to use it as the basis of a financial product, they'll do so. If you think about the development of commodities benchmarks, if a benchmark becomes something that people want to reference in their bilateral contracts, or they want to use as the basis of an underlying or as the underlying interest in a futures contract, it will become the benchmark. And benchmark providers actually don't make things benchmarks. The market makes them benchmarks. And the next point is that I think we all agree that investor protection is an important regulatory objective, but I think when we talk about the fit for purpose or fit for use question, an important thing to keep in mind is that we have to determine who's best suited to determine whether a benchmark is fit for a specific investment purpose. And I would say that benchmark providers, because we don't determine what a benchmark is, are not best suited to do that. The investment community is, market authorities are well equipped to do that. And so it shouldn't be the benchmark provider that does it. I do think, though, that an important regulatory objective and a view that we share, is that steps should be taken to show that an index provider, if it's going to be used as a basis of a financial product, doesn't have conflicts of interest. It has good governance, policies and procedures, audit trails, and these are all things that I think are fully consistent with what IOSCO did. And if you look at the IOSCO reports that we have published on our websites, both on the Platts side of the house and the S&P Dow Jones side of the house, I think you'll see that we've demonstrated not only that we agree with those principles, but that we are willing to show how we have implemented them, just as IOSCO had requested us to do. And the last point is just I think that, and I think it's consistent with what others have said, IOSCO should really be used as a baseline. With due respect to Maite, who I've gotten to know over the last couple of years, I think that the European Commission proposal of September 2013 does go quite a bit beyond the IOSCO approach, and I question whether it's necessary in a lot of markets outside of the critical benchmark space. I think I've sort of covered this, but I'll just reiterate that I think the objectives of any regulatory outcome should really be to ensure that the benchmarks are produced with integrity and are sound and have good governance. This is a great topic if you've been around Brussels. The third country regime and what to do about it is very complicated, complex, and you know, if you're sitting there as a private company and an index provider and you see what IOSCO has done, and you look around the globe, excuse me, and you see that a lot of countries and a lot of jurisdictions and a lot of index providers around the world have adopted the IOSCO approach, you see that there is a globally consistent approach already in place. And you hear arguments that it's not sufficient. I can explain to you in detail on the coffee break if you want to, if you need bedtime story or something, how they are quite sufficient. They have teeth, the IOSCO principles. I think the proof is in the pudding with this in a way, because the major index providers around the world have actually implemented them because it's necessary for us to do so from a market perspective in any event. I think the IOSCO approach could be used as a globally consistent approach. It could be adopted formally. There are mechanisms. You could have a mechanism whereby the audits that are already being performed could be certified by ESMA or others. The point is that there is a globally consistent mechanism already in place, and that could be used to fit into what I think the union is trying to do. One other thing on that is Maria Teresa and others have said that the equivalence regime will work because other jurisdictions are putting regulation in place. I don't think that excuse me, is happening in the way that would make any jurisdiction around the world equivalent. And the reason I say that is because the indications we have of any of the jurisdictions that Maria Teresa mentioned, from whether it be Hong Kong, Japan, now Canada, other places that are considering what to do in this space, none of them are contemplating a regime which is similar to the EU regime. And so I would dare say that you won't have equivalence, because what's been demonstrated so far is that there are going to be very, very differentiated approaches from the one that the European, the Commission has put forward September last year. Excuse me. In terms of transparency, this is a long slide, but what it basically says is that contributions are not homogeneous, they're heterogeneous, and there should be a differentiated approach based on the type of benchmark that you're thinking about. I think it's fair to say, and I think we all recognize in the index provider community, that if you have a benchmark that is based on estimates, opinions about potential market activity or a market that's dried up, you're going to be, and those people have a vested interest in the outcome of the benchmark, it's going to be more likely that the conflicts of interest that are there will come to fruition, and you could see people behave inappropriately in that context. But not all benchmarks are constructed that way, not the ones that we produce. We produce, both on the Platts side and the Dow Jones index side, indices and assessments that are based on actual underlying markets with real market activity. These aren't guesses. These are people observing markets and then putting out either an index measurement of that market or an assessment of what the price might be in a commodity in that market. So I think that the rules about transparency need to be differentiated on the nature of the contribution, the nature of the underlying market, and whether the contributor, very importantly, whether the contributor has conflicts of interest. Because to me, when I look at the LIBOR scandal, at the other similar scandals that have unfolded, it's all about conflicts of interest. It's all about whether the person has a vested interest in the market that they're measuring. And I think that's absolutely the most important thing. And as an independent index provider, we don't participate in any of the markets we measure. We're not participating in those financial products, and it gives us an independence and a freedom from conflicts of interest, which I do think matters a lot in this context. In terms of auditing data, I think the IOSCO approach, which we adopt and accept, calls on index providers to adopt good governance procedures, but it also calls on index providers to maintain audit trails in the event that an administrator's governance and processes need to be demonstrated, and we think we're doing that already affirmatively by putting out the audit reports, that the calculation of a benchmark or determination needs to be reviewed. In other words, if there was a mistake or somebody thinks there was a mistake or somebody thinks that somebody tried to distort a benchmark, if you have that information available at the index provider, it can be given to the regulatory authorities if they demand it, which has happened in the course of various inquiries. And we have that information available, and we think it's a good thing to keep it for all benchmark providers. And then the third point was the point I just made. The second point is really whether or not we did our job well, whether we calculated the benchmark appropriately. So I know I'm just about out of time, but I would just wrap by saying I think, as I said, the main distinction I see between the types of benchmarks that have had issues currently and in the past and others are whether or not there are conflicts of interest and whether or not the people who are administrating them are independent and have robust governance in policies and procedures, and I think that's key. I think the second point is that we absolutely support the objectives that we've heard from IOSCO, from others, that we should have good governance, that we should be transparent. Those are all things we support. But I do think that there really needs to be a proportional approach to any regulation, because there really isn't a one-size-fits-all solution here. And what we do is very different from what others do. On transparency, I didn't talk about IP, which is surprising because I'm an IP lawyer by background. But the regulatory objectives can be, again, proportional. I don't think you need to disclose every bit of information that an index provider has and ruin business models, because it's not going to achieve the objective that regulators are trying to achieve. It's just going to be a bunch of data flooded into the marketplace. And if you put things like our weightings and our other intellectual property out there, all of that information is not going to give any real significant improved perspective to investors, and that's what this is supposed to be about. The fourth and final point is I do think we need to see a differentiated approach to make sure that people have the information that they need, independent index providers, to publish independent and sound benchmarks, because again, what this is really about is providing transparency into markets. And if people like us can't do our jobs, those markets will become more opaque. They will not become more transparent. So thanks.